Welcome to US Tax Classroom. This is the fourth and final explainer in our mini-series covering the standard deduction and itemizing. Over our first three explainers, we laid down all the groundwork. We defined exactly what the standard deduction is, and we took a deep dive into every single category of itemized deduction you can possibly take on Schedule A. But right now, we are arriving at the core decision. Which one should you actually choose? In principle, the answer is incredibly simple. You just take whichever option gives you the larger deduction. But knowing exactly how to figure that out and understanding how your unique life circumstances tip the scales one way or the other, well, that is exactly what this explainer is all about. Let's dive in.
We've got a great roadmap for today. First, the basic tax rule. Second, when the standard deduction wins out. Third, when itemizing wins out. Fourth, a really close call. Fifth, the bunching strategy. And finally, figuring out exactly which taxpayer you are. Section 1. The basic tax rule.
The core rule here is incredibly straightforward. First, you add up all of your qualifying itemized deductions from your Schedule A. Then, you simply compare that total number to the standard deduction for your specific filing status. And then, you literally just take whichever number is bigger. It's that easy. Now, for the average taxpayer, the standard deduction is typically the way to go. But if you have significant charitable gifts, high state and local taxes, or huge mortgage interest expenses, itemizing could save you a lot of money. To figure this out, you need to know the exact score to beat. So, I'm going to read out the 2025 standard deduction baseline amounts for you nice and slow so you can lock in the number that applies to you. If you are single or married filing separately, the target to beat is $15,750. For head of household, the baseline is $23,625. And for married filing jointly or qualifying surviving spouse, your hurdle is $31,500. Memorize your number, because those are the exact amounts your itemized deductions absolutely have to clear for itemizing to win out.
Section 2. Standard wins. Let's look at Lisa.
Meet Lisa. She's a single filer, and she has an adjusted gross income, or AGI, of $60,000. During 2025, she had a few notable expenses we need to look at. First, her out-of-pocket medical expenses. Now, as a quick reminder, you can only deduct medical expenses that exceed 7.5% of your total income. So this is just the qualifying amount that actually cleared that hurdle, which comes to $3,500. Next up, her state income tax and property tax combined, what we call the SALT deduction, came to $6,000. And finally, she made some generous charitable contributions throughout the year, totaling $2,000. Okay, let's build the math together. We take her medical at $3,500, we add her SALT at $6,000, and then we tack on her charitable giving at $2,000. Adding all those up gives Lisa a total Schedule A itemized deduction of $11,500. Now comes the crucial step, the comparison. We place her $11,500 itemized total right up against her standard deduction. Since she's a single filer in 2025, her standard deduction is $15,750. The verdict here is crystal clear. $15,750 is undeniably greater than $11,500. So the standard deduction wins hands down for Lisa. By taking the standard deduction, she gets $4,250 more in deductions than if she had chosen to itemize. In fact, if Lisa had somehow insisted on itemizing, it would have literally cost her money. And honestly, this exact scenario is the reality for most taxpayers. If you're a renter without a mortgage, if you live in a lower tax state, or if you just don't have massive out-of-pocket medical expenses, the standard deduction is practically always going to win out. Section 3. Itemizing wins. Let's look at Tyler and Sarah. Let's meet Tyler and Sarah. They are a married couple, they're filing jointly, and they have an AGI of $150,000. Unlike Lisa, Tyler and Sarah have some major heavy-hitting expenses. First up, they have a large loan, and the mortgage interest on their $600,000 mortgage came to $28,000 for the year. Second, their state income tax and property tax combined came to $22,000. And lastly, they made charitable contributions totaling $8,000. So let's run their math step by step. We take $28,000 for the mortgage, add $22,000 for the SALT deduction, and layer on $8,000 for charity. Adding all of those together gives Tyler and Sarah a massive Schedule A itemized deduction total of $58,000. Now, we compare that directly to their standard deduction. Because they're married filing jointly, their 2025 standard deduction is $31,500. And obviously, $58,000 is significantly greater than $31,500. Itemizing is the clear, undisputed winner here. Because they chose to itemize, an extra $26,500 of their income is now entirely protected from taxes, compared to taking the standard deduction. That is a massive, highly meaningful difference for their final tax bill. And this brilliantly illustrates the situation for a lot of homeowners. When you have a substantial mortgage, you live in a higher tax state, and you do a lot of charitable giving, the combination of your mortgage interest and your SALT deduction alone frequently pushes your total way above that standard deduction baseline.
Section 4. A close call. Let's look at Marcus.
Meet our final persona, Marcus. He's a single filer with an AGI of $80,000. Now, during 2025, Marcus actually had a mortgage, but his numbers are quite a bit lower than Tyler and Sarah's. Let's walk through his expenses. His mortgage interest came to $12,000. His combined state and local taxes, his SALT, came to $7,000, and he made charitable contributions of $1,500. So let's build the total. We have $12,000 plus $7,000 plus $1,500. Let's see exactly how Marcus stacks up. Marcus's total Schedule A itemized deductions add up to $20,500. We compare that to his single standard deduction of $15,750. Yes, $20,500 is greater, so Marcus should definitely itemize. However, take a close look at the math here. He is only winning by $4,750. The margin is actually quite narrow. And, when your margin is that narrow, it completely opens the door for a very clever tax move.
Section 5. The bunching strategy. Because Marcus's total is hovering so near the threshold, he is the absolute perfect candidate for a powerful technique called the bunching strategy. Here is exactly how it works to maximize your tax benefits across multiple years. Let's take his charitable donations as our target. Instead of donating $3,000 to charity every single year, you group them. You donate $6,000 in one year and then absolutely zero the next year. In the year you donate the $6,000, your total itemized deductions spike way above the standard deduction, making itemizing a massive win. Then, in the off year where you donated nothing, your total drops, so you simply fall back and take the standard deduction. Over a 2-year period, you've donated the exact same amount of money, but you've completely maximized your tax benefit by concentrating the deduction into a single spike year. This strategy is fantastic for charitable contributions because your timing is flexible, unlike something like medical expenses or mortgage interest. Section 6. Which taxpayer are you?
So, let's zoom out from our specific personas and look at the universal rules. On the left, we have our itemizers. This usually makes sense if you own a home with a mortgage. It's also highly relevant if you live in a high tax state like California, New York, New Jersey, or Illinois. This is especially true now that the SALT cap has been raised to $40,000 for 2025 through 2029. That makes itemizing far more attractive than it was under the old $10,000 cap. Having significant medical expenses or making large charitable contributions also firmly puts you in this category. Now, on the right, we have the standard deduction winners. If you rent, you lose the two biggest itemized deductions, mortgage interest and property tax, so the standard deduction almost always wins. If you live in a low or no income tax state, it's really hard to clear the threshold. And crucially, if you are 65 or older, you get enhanced senior deductions. When you combine the standard deduction plus the $2,000 senior addition plus the new $6,000 senior bonus deduction, the bar for a single senior to itemize is now a massive $23,750. That is a very, very high bar to clear. But listen, if there is one golden rule, one ultimate takeaway from this entire explainer, it is this: run the numbers both ways every single year. Never, ever assume. Fortunately, most tax software does this automatically for you in the background. You just enter your expenses and it picks the larger one. But you have to put the data in. Don't assume the standard deduction always wins, because getting a new mortgage could change that instantly. And don't assume itemizing always wins, because if you pay off your house, your deductions will drop and you might fall short. Life changes, and tax laws constantly change right along with it. Check it both ways every single year. And that officially wraps up our full 4-part mini-series on the standard deduction and itemizing. We have covered all the basics, the schedules, the math, and the advanced strategies. So the real question you have to ask yourself now is, will a life change or a new tax law flip your deduction strategy next year? Thank you so much for joining us for this series. Please make absolutely sure to subscribe to US Tax Classroom so you don't miss any of our future explainers, and be sure to check our community posts for quizzes to test your tax knowledge. See you next time.